Welcome to session 9, where we are going to dive in and dive deep on how to apply for a mortgage and be successful. Let's dive in. Now, preliminary, I would type in on Google mortgage calculator and start typing in some of the inputs they have. It's a good rule of thumb and a good start. It is not the end all be all though. So take it with a large, big grain of salt and not take it as gospel, please. So let's say the mortgage calculator says you were able to afford a $500,000 mortgage. That's a $2,360 payment based upon what you typed in on these inputs. That does not take into account all the future things that may happen. So the application here is to not take it as gospel, obviously, go back to the last clip, but the reality is life may change in the next 3, 5, 10 years, the time you will be living in the house, whether that be children, whether that be children leaving, whether that be you needing a bigger home for whatever reason. Take into account the mortgage calculator, but also take into account your future goals, because that truly is a far greater factor in figuring out how much you can afford for the mortgage. The reality is we created this whole entire down payment movement to help you with the down payment of a home, and that is the next thing I'm going to touch on. Saving up for a down payment is super important, and having 20% down benefits you for a variety of reasons. It shows the lender that you're less risky because you're super responsible and have 20% saved up. And a biggest deal is you don't have to pay for PMI, which is private mortgage insurance. And insurance you have to pay all the way up until you hit that 20% threshold. And obviously your monthly mortgage is going to be lower than if you put down, say, 5, 10, or 15%. And it's just a good thing to really get those habits of consistently putting money into savings and not touching it for any purposes other than a complete emergency, and I do mean emergency, big E emergency, or making a large purchase like the home. So if you're able to show a lender that you are super responsible, and I do mean super responsible, having 20% down, it's going to help you secure that mortgage a little more easily than someone, or if you were not to have that 20%. As my grapes are talking to me and getting in the shot. If you're in this far in the session or in the series, then you obviously know there are different types of mortgages. If you don't, right now I'm going to touch on all 4 different types of mortgages out there. First one being a conventional mortgage. A conventional mortgage has a couple pros and a couple cons. The pros are you have a fixed principal and interest payment that are going to stay the same the whole entire time throughout the loan, and your interest rate cannot change. That's part of the deal. The cons are if you need to refinance it, the cons are if you need to take advantage of lower interest rates, you need to refinance the loan. And it's best for if you were hoping that interest rates are going to rise in the future. It's good for you. And knowing you have a consistent payment throughout the whole entire time of the loan is also something beneficial. So if you like steady Eddie, things that stay the same, conventional is probably going to be the best bet for you. The next type of mortgage is a ARM. No, not that kind of ARM. An adjustable rate mortgage. And there's a couple things to touch on here. They typically have lower interest rates in the beginning, a teaser rate for between 3 and 10 years, and the interest rate is going to change every year after that fixed term. It can go up, it can go down. It stays within a threshold, but you won't know from year to year what the interest rate is going to be. It's based upon the market. And lastly, this is for someone who wants the lowest monthly payment in the beginning, but again, it's just a teaser rate. Remember that it's not going to stick for the whole entire time of the loan. So I encourage this one's a little, I'm leery of the ARM, just because it can change every single year after that. So if interest rates rise 0.5% each year for 5 years, you're gonna have a 2.5% higher mortgage, which makes the payment obviously higher. Now, it may go down. I don't see that happening going forward with 2018 and going forward, but perhaps it's possible. But just know that that is the best. You have the lowest payment on this mortgage. However, the interest rates will change every single year after that initial rate. So take into account before you choose an ARM. Thirdly, there are FHA loans. which is the Federal Housing Association or Allowance, I forget. Anyway, so they help. You can put down as little as 3.5%, and maybe a little bit more depending upon your credit score. If you have something above a 580, 3.5%. If you have below the 580, you usually need to put down 10%. And there are lots of different fees and such with these loans. Mortgage insurance, obviously. Unless you are so hell-bent on buying a home, this may not be the best solution. Although you need very little down, it's not always the best decision to buy something with such a little amount down. However, if you have bad credit or very little to put down, this is definitely the best option for you. And lastly, the VA loan. If you are a veteran of armed forces, which I thank you for your service, thank you for keeping me free in this beautiful country. Thank you for your service. I have no other way of putting it. Thank you very, very much. You can qualify for a VA loan. And this typically requires 0% down. So you're able to finance 100% of the purchase price, which can again be a pro and a con, because having zero money down is nice because you don't have any money down, but it does make that mortgage payment higher, and you do pay a lot more interest just for having 0% down throughout that time. There are fees ranging from about 1.25% to about 3.25% for creating this type of loan, and there's a limit on how much you can borrow. They won't give you $1 million on 0% down. That just doesn't exist. And they are available to people who are on active duty, veterans, or widowed spouses of people who are in the armed forces. So if you fall into those three categories, you may be able to qualify for a VA loan with the 0% down and the things I just touched on. Could be a solution for you if you have that connection with our armed forces. Those are the four. If you are that is the number of this series, 4. I think that's my new favorite number. Anyhow, those are the 4. If you're unsure which category would be best for you, talk to a mortgage professional or a financial planner of some sort to see what the pros and cons are specific to your situation. Every situation is very specific and very different, so don't take my advice as gospel or my information. Talk to a professional who knows your situation in and out. Shop around for your lender. There are more than a few 100,000, I don't know how many are there in the country. There are so many different lenders, and they offer very similar products. There's not one that has the best product in the whole entire nation. It doesn't exist. So shop around. Customer service is key. You will be working very closely with this person, gathering all your financial documents, everything. So the takeaway here is to, again, talk to your circle of influence. If anyone's bought a house recently, ask them who they went through. If they had a good experience with them, I'd encourage you to go through them. Google, Yelp, there's so many different ways to figure out a good lender. But just know that you'll be working very closely with them. They will know all of your financial data, so obviously you want to feel like you trust this person, but know that there are so many different options for you that you should find someone who's going to treat you very, very well. All right, so now you have the lender, the interest rate, everything that you think you're going to go with. There's a few different things you want to gather to really start the process rolling full speed. You'll need proof of income. Your W-2s, 1099 if you're a contractor, all those things to prove income. Tax returns from usually the last 2 or 3 years. So make sure to have all of that handy. Proof of employment, so pay stubs on where you work currently if you were a W-2 employee. All of your assets, vehicles, motorhomes, motorcycles, boats, airplanes, private jets, whatever that is a asset, have a list of that in full. A list of all your liabilities and debts, everything and everyone you owe money towards, and everything that you owe money on, have a list of that. And lastly, an explanation for large sums of money, transactions, things of that nature. I was asked why I had a different mailing address as opposed to the home I lived in. And the reality is I just had a mailing address that was different because I didn't want people to know where I lived. I'm a little paranoid when it comes to that. So you'll have it explained truly. They will give you a full examination on everything financial, who you are, what you've been. So be ready for that interrogation process, it seems. Don't fret though, it's not because they really care about, what your mailing address is. It's just for them to understand where you're coming from and how they can serve you in the best way possible, and for them to understand where you are as a consumer and be able to help you in the best way. They definitely want to see your bank account statements, so have those statements ready to show them. That's probably one of the biggest things I definitely did miss. So your bank account statements are going to be very beneficial to you, having all of them for the last couple years. Session 9, done. Fin. Session 10 is going to be all about, is it better to have a 20% down payment for a home? Here's the answer, it's yes. But I don't want to spoil it for you. Go to session 10 and figure out why that's the case. Session 9 complete. See you guys soon.